Did you know that as a W-2 earner making less than $400,000 a year, you could be missing out on thousands in tax savings? In this video, we'll be breaking down straightforward and effective tax strategies to legally reduce your tax bill by utilizing benefits that you may already have through your employer. By the end of this video, you will have the knowledge to minimize your tax liability legally and efficiently. If you're new to the channel, my name is Zagmout. I am a certified public accountant and a wealth advisor. Side note, I personally believe that we are failing as a society because we don't teach financial literacy. I believe schools are failing our kids by not giving them the tools to stand on their feet financially. I also believe that we are failing as parents by not providing our kids the rules of the game to become independently wealthy. Maybe because we don't know the rules ourselves. Maybe some of you grew up in households where your parents weren't financially literate. My goal by posting this video is to explain tax and financial strategies to individuals like you in a simple and easy to follow steps, helping you build wealth and minimize your taxes. Hopefully we can close the gap together. So I will help you by explaining certain benefits that your employer may already provide you as part of your benefit package, as some of these benefits may drastically reduce your taxes. Without further ado, let's dive in. Let's start with the 401k and 403b retirement plans. If you are working in private sector, you are likely using a 401k. If you are employed in public schools or certain nonprofits, like a hospital for example, you're probably dealing with a 403b. These are the most common retirement plans, and they derive their name from sections of the US tax code. Regarding contributions, for 2024, you can contribute up to $23,000 to your retirement plan before taxes are even applied. In 2025, this amount increases to $24,000. If you are 50 years old or older, you can contribute an additional $7,000. These limits are adjusted for inflation, so they increase slightly each year. The money you contribute grows tax-free until you start withdrawing it, typically after retirement. This allows your investment to grow without the burden of taxes until you begin taking distributions. Many employers offer a match on your contributions, which is essentially additional compensation. For example, if your employer matches up to 3% of your salary, ensure you're contributing at least that amount to take the full advantage of the match. When it's time to withdraw funds, usually after you reach 59 years and a half, you will pay tax on the distributions since the contributions were made pre-tax. By then, you will hopefully be enjoying your retirement. Number 2, commuter benefits, which can help reduce your taxable income by using pre-tax dollars to cover your commute. This is an effective way to lower your tax liability while covering necessary expenses through your employer's commuter benefit program. You can set aside a portion of your pre-tax salary each month for transportation costs. For 2024, the IRS allows you to allocate up to $315 per month for public transportation and an additional $315 for parking expenses. These benefits can be used for a variety of transportation-related expenses, such as public transportation, ride-sharing services, or parking fees. To get started, check with your HR department to see if your company offers these benefits and how you can enroll. Typically, you can access your funds through a prepaid card or a reimbursement account. Commuter benefits not only make your daily commute more affordable, but also help you save on your taxes, enhancing your overall compensation package. Number 3, medical expenses. If you have significant medical expenses, there's potential for substantial savings. You can deduct medical expenses that exceed 7.5% of your adjusted gross income, the AGI. This includes surgeries, dental work, and preventive care. Keep thorough records and receipts throughout the year to maximize your deduction. For example, if your AGI is $100,000 Any medical expenses over $7,500, which is the 7.5% of the AGI, as I mentioned earlier, may be deductible. However, if your expenses are below that threshold, you won't be eligible for this deduction. To bypass the 7.5% threshold, consider using a health savings account or an HSA or a flexible spending account, FSA. These accounts allow you to pay for medical expenses with pre-tax dollars, further lowering your taxable income. Number 4, HSA, Health Savings Account. The Health Savings Account, HSA, is a powerful tool for those with high deductible health plans. It allows you to set aside pre-tax money to cover medical expenses, including deductibles, co-pays, and co-insurance, reducing both your healthcare costs and your tax liability. You can also invest the funds in your HSA in stocks, bonds, mutual funds, and other investment vehicles. The earnings from these investments are tax-free, which can significantly enhance your financial resources, especially in retirement when healthcare costs typically rise. Maximizing your HSA contributions and allowing the funds to grow can provide substantial benefits in the long term. Before we dive into the next section, I would love to hear from you. Are you already using any of these strategies? Got questions about other ways to save on taxes? Drop your thoughts in the comments below. I'm all ears. And hey, if you're enjoying the video, don't forget to give it a thumbs up and hit the subscribe button. That way, you will stay in the loop on all things tax and finance. All right, let's move to the next tip. Number 5, FSA, Flexible Spending Account. A flexible spending account, FSA, is another tax-saving tool, helping you cover out-of-pocket healthcare costs such as prescriptions, deductibles, and co-pays using pre-tax dollars. This can result in significant tax savings. However, it's essential to note the use it or lose it rule. If you don't spend the money in your FSA by the end of the year or any extension period your employer may offer, the remaining funds are forfeited. Therefore, it's crucial to plan your healthcare saving carefully. Number 6, Dependent Care FSA. A Dependent Care FSA allows you to use pre-tax dollars to cover childcare costs and other dependent care expenses. This includes daycare, after-school programs, summer camps, and care for adult dependents. This account provides a significant tax advantage, helping you manage the high costs associated with dependent care. Number 7, 529 Plan. The 529 Plan is a tax advantage savings plan designed to help you save for future education costs. These plans are flexible, covering everything from college tuition to K-12 expenses. The earnings in a 529 plan grow tax-free, provided they are used for qualified educational expenses. Additionally, certain states offer extra benefits on your state return, further enhancing the value of these plans. Number 8, Charitable Contributions. Charitable contributions can also help reduce your tax liability if you itemize deductions. This includes donations of cash, goods, or property. It is essential to keep detailed records of your contributions to ensure they can be deducted. Even small contributions, such as out-of-pocket expenses incurred while volunteering, can add up and contribute to lower your tax bill. Number 9, Educator Expense. For teachers and educators who spend their own money on classroom supplies, there is a deduction of up to $300 available. This helps offset the cost of necessary supplies and materials used in a classroom. Number 10, Student Loan Interest Deduction. If you're paying interest on student loans, you may be eligible to deduct up to $2,500 of that interest, depending on your income. An important update to this deduction is that even if someone else pays off your student loan, lucky you, the IRS treats it as though that person gave you the cash and then you used it to pay the debt, as long as you're not claimed as a dependent on someone else's return. you can still deduct up to $2,500 of student loan interest. Number 11, gambling losses, W2G. If you've had gambling winnings, the IRS requires you to report them on your tax return. You may receive Form W2G depending on the threshold, depending on how much you won, and that form can be given to you or mailed to you either from a casino, online gambling platform, DraftKings or any other online casinos. However, you can deduct your gambling losses up to that amount of your winning. Proper documentation is crucial to claim this deduction. Number 12, long-term capital gain. Long-term capital gains are taxed at a lower rate than regular income if you hold investments for more than 1 year before selling. This provides an incentive to adopt a long-term investment strategy. For those in a certain tax bracket, the tax rate on long-term capital gain can be as little as 0%, allowing for significant tax savings. Number 13, minimal rental use Augusta rule. The minimum rental use allows you to rent out your home for up to 14 days per year without paying taxes on the rental income. This can be particularly beneficial if you rent out your home during major events or holidays. Number 14, traditional IRA. Traditional IRA is a versatile retirement account that offers tax-deductible contributions depending on your income level. It provides an opportunity to lower your taxable income while building your retirement savings. With a traditional IRA, you have greater control over your investments, and the tax-deferred growth allows your investments to grow without taxes until you withdraw the money in your retirement. Number 15, tax loss harvesting. Tax loss harvesting involves selling investments at a loss to offset capital gains, thereby reducing your tax liability. It's a valuable strategy, especially as the year comes to an end. When selling investments, make sure you have accurate records of your cost basis to avoid any issues when filing your tax return. All right, that's all for today's topic. I really hope you found this information helpful. If you're able to save some money on your taxes, enjoy those savings. I'm genuinely happy for you. If you liked what you saw, please consider giving this video a thumbs up. It helps me understand what content you find valuable so I can create more of it. Thank you so much for your support, and I'll see you in the next video.